Everyone says just file an LLC. Sounds safe, right? But in healthcare, that advice could cost you your clinic, or worse. The truth is, one wrong form can mess with your taxes, blow your liability protection, and even break the law. In this episode, I'll break down the real difference between LLCs, S-Corps, and professional corporations, and why most startup lawyers get this totally wrong. And if you stick with me to the end, I'll show you the one legal structure that actually protects healthcare founders like you. I've worked with a lot of business clients, and some people have come to me as sole proprietorships, LLCs, S-Corps, and already formed professional corporations. And a lot of what a business attorney does is sometimes do a lot of the cleanup of what was already done. And so I had a client where they came to us, they were an LLC, they thought they did everything right, and it turns out that they had not made a professional election. And actually, the medical board was upset with them for a number of other things, but one of their big points was that they failed to report as a professional LLC. This was in Minnesota. And so what that meant was simply by choosing the wrong entity, they were now in trouble with the medical board. Not a fun place to be. And really just an easy decision to make from the get-go. An entity can be changed a little bit later, but it becomes annoying and financially burdensome to do so. And so what I'm going to do is I'm going to break down the top 3 legal entities from the start. Let's start with what most people will start with if they don't file an entity, a sole proprietorship. So sole proprietorship is just a fancy way of saying that you are doing business for yourself. You don't have a legal entity. You can go open a bank account. You can get insurance. You can technically hire other staff, but you don't have a liability protection. Hence the whole point of the next entity, which would be a limited liability company. And so a limited liability company is going to create a front line of defense between you and the wild world of liability and risk and damages. And what it'll do is it'll actually absorb a potential lawsuit that comes in based on you doing business. In this case, anything medical, healthcare related. As long as you're doing your core business function, you make an error, that's okay. It's not great, but at least that liability will stop at your company and not go and touch all of your personal assets like your car and your home and cash in any of your accounts, retirement accounts, anything like that. And so LLCs can actually be taxed a variety of different ways, which is kind of confusing. You've probably seen it on a W-9 form or a 1099 form where you got to check one of the boxes, and an LLC can actually be taxed a variety of different ways, one of them being an S-Corp. Kind of confusing. So, for example, Holt Law LLC up in Minnesota is taxed as an S-Corporation. It's actually a tax election provided by the IRS and not really technically an entity by itself. That's where people get confused. Now, S-Corps are all the rage, and I'm a big fan as well. I think that when you're really breaking down what it is from start to finish, usually, the quick advice would be, if you're making pretty good money, you should probably be an S-Corp, but it's totally okay to start as an LLC. Obviously, talk to an attorney or a CPA before you file. That's going to be the best advice. But if you're just watching this podcast, you would probably be in Minnesota, an LLC with an S-Corp election. But you also had to add on that professional firm's election up in Minnesota. That brings me to another entity, a professional corporation. So a professional corporation simply means I'm a corporation, but I'm owned by licensed professionals, like a medical doctor, like a nurse, like an attorney. So attorneys, we're actually quite similar to doctors in how we are regulated with our licenses. We have our professional licenses, we have our professional corporations. In California, for example, they do not allow professional limited liability companies. So Holt Law in California actually is a PC, or professional corporation. Really, all that means is that, similar to a limited liability company, a corporation is going to block the liability, but you got to be a little bit more careful with some of the corporate formalities as well as the taxes. And so let's go back a second and talk about what each one means in terms of the setup itself. So the setup for these is going to go from nothing with the sole proprietorship to quite a bit of formalities with the corporation. The LLC is kind of right in between. Filing is pretty easy in most states. It's generally online, electronic, and in most states, same day. But it's what you do after the filing, which is going to help build that wall of protection. So me just filing an LLC, that's great. That's a good first step. But then I actually need to behave and act like an LLC. So I can't just have all my personal credit cards and personal stuff in with my medical business. I need to put actual business things in the business and keep personal things outside of the business. So that's going to be a big thing. As well as I need to open a business bank account, have insurance for the actual business, and ideally take written actions and have a little bit of formality with when I'm making business decisions. Now, this can be a little less formal if it's just a single owner, corporation or LLC, but certainly when you have multiple owners, you need to think about these formalities. Otherwise, it's an absolute mess if there's any sort of breakup or audit from the government. Let's just take Minnesota and California, for example. And so in Minnesota, there's also what's called the corporate practice of medicine doctrine. And so it kind of limits who can own a medical company. Up in Minnesota, that needs to be a licensed professional. But it's a little unsettled as to whether it has to be a medical doctor all the way, for example, or over 51%. In California, a professional corporation that's doing a medical practice must be 51% owned by a medical doctor. And so the structure that's allowed, as well as who can actually own it, is going to vary by state. It's absolutely critical to at least check with the business attorney for such a critical decision in not just your liability, but also your taxes and really the name for your business itself. All right, so now that we've talked about the actual formation of the entity, let's transition and talk about the taxes behind that formation. So you may think that your LLC is protecting you until you realize that you didn't like and subscribe on the David Holt Show. No, but seriously, you may think your LLC is protecting you, but it turns out that it's full of holes because you're getting hit with a self-employment tax and you didn't actually file it correctly to begin with. And now when it comes tax time, you are overpaying on taxes. Let's dive into what we could have done differently from the start. So one of the biggest reasons why we pick an entity is to save in taxes. We call this paying the legal minimum. There is nothing to be shy about, and there is nothing wrong with paying the government what we owe them and nothing more. Now, if you'd like to pay more, that is perfectly fine. You can donate. You can choose the entity structure that actually pays more in taxes, that one probably being just a straight up sole proprietorship or LLC, where the money is actually coming through to you as a single member LLC and you're paying what's called a self-employment tax. So self-employment tax is where the state will charge you taxes on that money that's coming in. It passes through to you, but it's at a not great rate. And so one way that we get around that is if we're an LLC, we can make an S-Corp election. So an S-Corp election really is just a fancy way to tell the government, the IRS, that we are choosing a structure that was lobbied for and is now there in the tax code on behalf of business owners and founders like you to take advantage of. And all it is saying, listen, I'm going to pay myself as an employee here, even though I'm an owner. So yeah, I'm wearing my owner hat, but I'm also going to be having my employee hat on now. I'm going to be drawing a salary over here as an employee. I don't know, maybe $60,000, whatever is reasonable in my industry. So it needs to be what's reasonable in healthcare, or for a doctor might be a little bit more. And then all the rest of the money, after I've paid my other employees and my business expenses and what have you, I'm going to take as a profit, or what's called a draw. And the reason I do that is because the government will actually tax that at a much lower rate than what it would if you were just taking all that money straight through onto you and your individual tax return. So that's why we do it right there. Really, it's just to save money on taxes. Now, it may seem weird that checking a box and doing things a little bit differently on your taxes all of a sudden saves you money, but that's the way that it works in business. And it's no different in healthcare businesses. And so usually an S Corp is where we're going to. The only reason that I might not do an S Corp right out of the gate is because you are going to pay a little bit more to your accountant and CPA to set everything up and to actually do that correctly. And maybe you don't have enough revenue right out of the gate to say, hey, I have enough to pay myself as an employee and then take a draw on top of that. You're just trying to make money that first year to scale up and get to that point to have the luxury of making that decision. So I respect that. So not everyone makes that S Corp election right out of the gate. Now, a corporation has the option to be taxed as an S Corp as well. It's just a little bit different on the filing. So if I was a professional corporation, right? So I'm a medical doctor or multiple medical doctors owning a corporation, I simply go and make that election as well. Otherwise, with a corporation, by default, you need to be careful with double taxation where you're paying both at the entity level and the individual level, which can easily be avoided if you're just thinking about the money that's coming in and being smart about why you're choosing an entity and how much we're paying in taxes. One thing I also want to touch on is LLCs. And by default, when clients come to me, it happens all the time. They filed their LLC, which I applaud. That's great. But they didn't know anything about taxes. They were using some online software. They were using QuickBooks. Totally cool. But they didn't realize that all of the money that comes into their LLC then attaches to them in what's called pass-through taxation. And so that money just goes right into the entity and right down to the individual. And now it's as if I am just, making money as a sole proprietor or making money as an individual. And we've really lost any of that tax benefit. And so, yes, we have the liability protection from the beginning, but we haven't done that next step to actually save money on taxes. Bottom line, S Corp, probably where you're going, maybe not right out of the gate if you don't have revenue. Professional corporations, simply be careful. Great that you have that liability protection, but be careful for double taxation, probably also going to the S Corp if you're doing it right. And finally, the LLC, which can be taxed many different ways, probably moving towards the S Corp, but right out of the gate, by default, if you don't do anything, it's simply going to come down and attach to you and your personal individual for your taxes. All right, so I'm going to tell you a story about one healthcare founder that started an LLC, actually with her husband, followed a little bit of YouTube advice, and then turned out that she couldn't sell her business. And this is why. So it turns out that with professional entities, when you are a licensed professional, in most states, you are not allowed to have unlicensed people also be owners. You often see this in husband-wife scenarios where the wife is a licensed nurse practitioner or medical doctor, and the husband, them working as a team, become 50-50 owners of a medical company. They file their own LLC. They don't realize it probably should have been a professional corporation or LLC to start. Everything's going fine. And then lo and behold, they walk into Holt Law and tell me that they are looking to sell the business. Now, the board never really knew about them because they didn't actually file anything with the medical board. They had actually done millions in revenue and not really had any issues. They had paid taxes and they were looking to sell their business. And I told them, as did the attorney on the other side, we can't do that because we actually have technically an illegal entity. Fortunately, we were able to save the deal. We did what's called an asset sale where we don't actually sell the company itself. We just sell all the nice things in it, like the furniture in a house. And so everything was fine in the end, but we probably lost quite a bit of money on that deal, or those sellers did, because they made the mistake at the beginning. They didn't set up correctly, and they didn't even know that you couldn't have unlicensed healthcare people inside of a medical practice as owners. This isn't like running a bakery or a car dealership. There are very specific rules in healthcare that are very nuanced state by state. And so the correct legal structure in Florida or Minnesota might actually be illegal in California. For example, with my own law firm, very similar to medical doctors, we're allowed to be Holt Law LLC up in Minnesota, but we have to be Holt Law PC or professional corporation down in California. They don't allow professional limited liability companies. And so what can work in one state might not work in another. And similarly, what may work for a baker or a car dealer absolutely will likely not work for a medical professional like a doctor or a nurse. And so I'm going to lay out the blueprint for what I think you should do. If you're listening to this podcast, and ideally you would talk to an attorney or CPA for your specific situation. But if I had to pick, the first thing that I'm going to be looking for in my state is whether there are professional corporations and professional LLCs available. If there are, then I'm likely picking between one of those two. Then I need to check on a pesky little rule called the corporate practice of medicine and make sure my husband, who's not a doctor and not a nurse, whether or not we can even have unlicensed owners in the picture at all. And then finally, I'm starting to think about when I'm going to make that S-Corp election. That's the three things that I'm going to look for to actually get to the best legal protection for audits, lawsuits, compliance headaches, and being able to even sell your business when we get to that point where you can finally say, hey, I'm ready to retire. I did almost everything right, but lo and behold, I accidentally filed the wrong entity. That's what we're trying to avoid. And if you think choosing the right structure is hard, wait until you try sharing ownership. That's where real money gets lost. But structuring your startup is only half the battle. In the next episode, we'll break down the $100,000 mistake healthcare entrepreneurs make when choosing partners and how to avoid it.